Today, the FOMC raised our policy interest rate by 75 basis points. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
These were the words of Jerome Powell at the latest Fed meeting. Another interest rate hike of 0.75%. Do you remember the words from a year ago? Inflation is just transitory. Here is Jerome Powell.
That inflation could actually be quite low. Our expectation is that these high inflation readings that we're seeing now will start to abate.
And now we hear a different story. 75 basis points up on interest rates. But everybody who listened closely already a year ago to Jerome Powell, he was always very, very clear. When inflation rises to worrisome areas, he will do what is necessary to bring inflation down. Here are the clips of Jerome Powell's speech a year ago, where he addressed how he will handle inflation.
Dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But
the latest speech from about a week ago.
If we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families. It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. We still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. We have some ground left to cover here, and cover it we will.
The Pesticides the All-In podcast discussed the reaction of the Fed to the inflation and came up with some serious comments and questions.
This is just, I think, an economy-wide slowdown.
What is the Fed going to have to do, or can they stop this consumer and this growth? It's very strange, right?
The big question still is inflation transitory? Will it be over pretty soon? Or is this a phase that, despite the interest rate hikes, is expected to last much, much longer? Here is the All-In podcast again.
Powell said he'd rather overcorrect and break things because he has a toolbox to fix the broken bones, but he doesn't have a toolbox to fix if they undercorrect and they have rampant inflation. I mean, not more explicit you can't get, Jason. So he's going to take rates until demand is destroyed, and enough demand is destroyed such that inflation is tamed. But that has huge implications to all of us because we all have to do our job trying to build a company, trying to raise money, trying to invest money. It's just getting much, much, much harder than I even thought. So for me, I'm like, wow, I thought that we could get through the worst of this by mid-23. But now you have to plan for the worst, which means, okay, now I'm thinking that, man, rates could be higher for much longer, which means, we could be in this market till early 25. And you may say, hey, that's way too conservative. Yeah, but you have to plan for conservatism in this point. So how do I invest money right now? Honestly, I'm like, I should just put it more into T-bills. Isn't that crazy? If a company's like Chamath can have another 10, 15, 20 million bucks, I'm like, wow. I mean, I don't think that gets you anywhere. And oh, by the way, that 10 or $20 million, I can generate 4%.
So finally, when we have the expectation that the next 2 years will be terrible in terms of inflation, recession, or even a depression, how should startups and households weather the storm and handle the situation? Here are also some sound comments and recommendations from the all-in podcasts investors?
Listen, it's survival of the quickest. Those who are most willing to adapt the most quickly are going to survive, and the ones that are stubborn and refuse to accept the new regime, the market regime, are going to die. We showed that chart. Remember that chart from Sequoia months ago on this podcast? Remember that? Where it basically showed what happens if you're a company that doesn't cut burn until the very end, then you're still going to run out of money and die. But if you make the cut right away, quickly, you have enough runway to weather the storm. And I think that what we've seen is, at my firm Kraft, this is exactly it. Yeah, we showed this months ago. We've been begging our founders to embrace this. We did a review with our entire set of founders of our portfolio companies. We did one in February when we felt the markets were changing, and we did another one in May, and we showed this slide. And this is the most important thing for founders to internalize, is you have to make the changes quickly. One way for them to think about it is, let's say you're a unicorn company, okay? And you raised at the peak, let's say second half of 2021, you raised $100 million at $1 billion valuation. And let's say you've got 50 million left in the bank, right? So you've burned 50 million. A lot of these founders are thinking that 50 million they've got left is only 5% dilution, but that's what it was historically. If you were to raise a new round today, you might only be valued at 250. So that 50 million you have left is actually 20% dilution. And that's if you could even raise, which might be very, very hard. The most important thing founders can do is forget about the historical terms on which you raised that money. Forget about how much money you were burning in the past. Just think about how much money you have in the bank today.
So to sum things up, 3 things need to be done. Number 1, increase your revenues to weather the storm. Solid cash inflows are always the best solution for everything. The second part is cut your expenses. Throw everything that you don't need in the coming 2 years out of the window. And the final third thing is stretch out your capital, your cash that you have, as long as possible. Make your cash last to survive the coming 2 to 3 years. Things will definitely get better afterwards. And I believe those companies who start right now with bootstrapping and those companies who are successful in increasing revenues, cutting expenses, and stretching their capital, their cash rich, will be extremely successful once the storm is over. I hope you enjoyed this episode. If you liked it, make sure that you subscribe to the channel to get more videos when I publish them.